So let's begin. So I want us to start with operating segments. Operating segments, so open with me that question. December 2014, question 4C. December 2014, question 4C. And for those without the past paper from 2015 going backward, I had scanned those questions for operating segment. I've shared to the group on the 2014. We do an operating segment. So just a quick recap, we said an operating segment is just a component of business which engages in business from which it may earn revenue and incur expenses, and whose operations are regularly reviewed by the chief operating decision maker. Then we say that we have two types of segment. One, we have what we call service segment. And also we have number two, geographical segments. Then we also said that how can you identify a reporting segment? We say that the criteria for identifying a operating segment, so criteria for identifying an operating segment, number one, is that you can identify an operating segment through its definition. Its definition as per IFRS 8. Number two, it has exceeded its quantitative threshold. That is, its reported revenue is greater or equal to 10% of the total segment revenue. Also, its reported profit, segment profit, is at least equal to 10% of the total segment profits, as well as its assets are at least 10% of the total segment assets. So that's how we identify an operating segment. Then we say that what are some of the disclosure requirements in relation to segment report? So disclosure requirement, or what are the content? The contents or the element of a segment report. We say number one, you have to show the profit. And for the profit, you have to separate those from the external customers or external profit, also as well as the intersegment. Then also you need to report the revenue, and the revenue do the same from the external and the intersegment. Then you need to show the assets, liabilities, depreciation, interest income and interest expenses. Also, you need to show admin expenses and any other specific income or expense. Good. So with that, let's do that question for December 2017. Sorry, December 2014, question 4C. So that I was just reminding you. So now let's do that question. And we are told that Wema Group Limited is a distributor of 4 products, P1, P2, P3, P4. The management of the group the management of the group has identified each product as constituting a reportable segment, namely segment P1, P2, P3, and P4. The management has also identified the countries of operation as country C1, 2, 3, 4, and 5. To position. So let's go to the additional information. Total depreciation for PPE was 120 million, apportioned in the ratio of 1.5:2 is to 1.5:1 for product P1 to P4 respectively. Number two, details necessary for preparation of segment report in relation to revenue and respective segment profit was as follows. So we have the segments, their revenue, intersegment revenue, segment profit before tax, and we have intersegment profit. Number three, other income and expenses was as follows. You have other income, interest and commission, cost of finance, amortization of intangibles. Number 4, the summary of assets and liability of the segment was given below. So you have those assets and liability, including the unallocated. Number 5, the following is a summary of the financial information relating to revenue and non-current assets within the countries the group operates in. That's what we call a geographical report. And we say that for geographical report, they only represent 2 items. That's the revenue from external customers and the non-current asset, nothing more. Required. With reference to IFRS 8 operating segment, prepare number 1, segment report for the group for the year ended 30th September 2014. And then number 2, a reconciliation statement for revenue, profit or loss, total assets, and liability. Yeah, we say that you only reconcile the 4 items. That's revenue, profit, assets, and liability. So let's present the segment report. This is Wema Group. Operating segment report. For the year ending 30th of September 2014. So we have segment P1, P2, P3, P4, and then you reconcile. And then you get the totals. So let's go to additional information number 2. Details necessary for preparation of segment report in relation to revenue and respective segment profit was as follows. So you have the revenue. And for the revenue, you have to separate the external revenue and the intersegment, so that now you get the total revenue. Then you also given the segment profit. So you get the profit. Also, you have to separate that external and intersegment profit. Then you get total profit. So let's start with the revenue. And the total revenue for P1 is 65. So we bring it to the total. 65. P2 we have it's 8,000. P3 55. P4 is 2,000. Then you also given the intersegment revenue. That's what you call the intergroup sales. And for P1 it's 400. P2 600. 800 and 200. Then, for example, for P1, if the total revenue was 6,500 and the intersegment was 400, so that means from external, it was 6,100. You take the total, you less intersegment for you to get for the external, and this one will be 7,400. 55 minus 8, what do you get? That one will be 40. 47. Is it 47? Yes. Then 2,000 minus 2, you get 18. We do the same for the profit. Do the same for the profit. And the segment profit before tax, P1 we had 800, 600, 700, and 350. Then we have intersegment profit. The segment profit for P1 we had is 50, 55, 70, and 25. So with that, now we can be able to get our external. You take the total profit 800, you raise 50 for the intersegment so that you get from the external, that's 750. 600, you raise that, you get 545. 700 minus 70, you get 630. 350, you get 325. Good. Then we need to incorporate the expenses. Let's go to note number 3. Number 3, we are told that Other income and expenses were as follows. So we have segment, we have other income, interest and commission. So for the interest and commission for P1 is 200, 200, 100 dash. So give me the total. 200, that's 500. You take it to the total. Then we have cost of finance, that's the interest. The cost of finance, we have 90, we have 60, 75, 25. That's 100, that's 150. So the total is 250. Then we have amortization of intangible. So for amortization, we have 50, 55, 70, 25. So that's 105, 130, that's 200. Then we also had another expense, which is depreciation. Let's go to note number 1. Note number 1. Number 1, you are told that the total depreciation for PP was 120 million, apportionable in the ratio of 1.5 is to 2 is to 1.5 is to 1. Can you add the total? 1.5 plus 2 plus 1.5 plus 1, that's 3, 4, 5, 6. So the total is 6. So this is what you'll be doing. So you take 1.5, divide by 6, you multiply by 120, and you'll get 30. Sorry for amortization. Sorry. For amortization was not this. I think those figures are wrong. For amortization, we had 30, 10, 10, 5. Yeah, that's 55. Good. Depreciation was 120. Let's continue the apportionment. Then you take 2 over 6. Multiply by 120. This one will get 40. This one will be 30. That's 1.5. And then we have 1. And this one will be 20. And the total will be 120. Just use that ratio. Number 4, the summary of assets and liability of the segment were as given below. So now incorporate the assets. For segment P1, we have it's 9,000. We had 4,000, 5,000, 2,500. Then we have unallocated. We say that for unallocated asset, you report it to the total, which is 2,000. So how much is the total? That's 13, 18, that's 2,500. So now we can be able to get the total assets. So the total assets will be 22,500. So that's the total assets. Can you go back to the balance sheet? Go to the balance sheet and confirm if the total asset is 22,500. Go to the balance sheet, confirm if the total asset is 22,500. Then we go back to note number 4 again. We incorporate now the liabilities. For liabilities, we have 1,600. We have 2,000. We have 14. We have 15. So add the total. That's 3, 4, 5, 65. Then we also had the unallocated. How much was unallocated liability? And allocated liability was 1,000. So you take it to the total. It's 1,000. So that means your total liability will be 7,500. Can you go to the balance sheet? Can you confirm if the total liabilities is 7,500? So you take the non-current liability. Non-current liability we have is 4,500. And then the current liability is 3,000. And the total gives you 7,500. But remember, I said that we usually reconcile 4 items: assets, liability, of which we have reconciled both the assets and the liability. Then also we need to reconcile the revenue and the profit. So let's reconcile the revenue. So for revenue, can you add the total from the external? Add the external revenue. And the total we have is 20,000. So report it to the total, 20,000. Then we also have the intersegment revenue, add the total, that's 2,000. But we say that the revenue which is within, that's what you call the intergroup sales, you eliminate it in full. So that means when you're getting the total revenue, if you take 6,500, you add 8,000, you add 55, you add 22, how much do you get? Should you get 22,000? Can you add that? Add the total revenue from the total column, and you get 22,000. Then you deduct the 2,000. That's what you call the intergroup sales, and you should get 20,000. So that's how we reconcile that. So can you go back to the income statement? Can you confirm if the revenue was 20,000? Was the revenue 20,000? Yes, you only recognize the revenue from external sales. You eliminate the intergroup sales. Let's do the same for the profit. Do the same for the profit. Add the total profit from external. And you'll get 2250. You report it to the total. Then also add the intersegment profit. And you'll get 200. So you take it to the reconciliation, but you deduct it. So now when getting the total profit, if you take 800, you add 600, you add 700, you add 350, are you getting 2450? That's 2450. Then remember, we see that for unrealized profit, you eliminate. So you eliminate 200 from the total, and you should get 2250. Actually, in short, what I'm doing is this one, I'm adding it to the total, 2250, I'm bringing it here, so that if you add the total, you eliminate the 200, you should get the profit from external sales. And that one should reconcile with what you have in the income statement. Let's go to the income statement. Is your profit before tax 2250? Income before tax should be 2250. Good. And we have answered part 1 and part 2. We have prepared the segment report and we have reconciled. Sometimes you also require to prepare the geographical segment. So let me show you how to prepare the geographical segment. So number 2, geographical segment report. Wema group. So in that case, let's go to note number 5. In note number 5, we are told that the following is a summary of financial information relating to the revenue and the non-current asset within the countries with the group operates. So you have countries, then we have revenue, and then we have non-current assets. For the geographical segment report, you only show the revenue from the external sales and the non-current assets. So you have C1, C2, C3, C4, C5. So you have 6,000, 55, 35, 25, 25. Non-current assets, you have 25. Then you can add the total. So how much is the total? That one should be 20,000. Current assets, 6, 10, 15, 18. Good. So you can take a screenshot of that. So let's try another question. And do another question. June 2012. Yeah, June 2012, question 4. June 2012, question 4. So part 4 of the question, part A, you are told that IFRS 8 operating segment is based on the core principle that an entity shall disclose information to enable users of the financial statement to evaluate the nature and the financial effect of the business activities in which it engages and the economic environment in which it operates. In light of this core principle, that IFRS 8 requires the disaggregation of the entity's financial statement into segments. Required. Define the term operating segment as used in IFRS 8, go through that, and we say that an operating segment is a component of business which engages in business activities from which it may earn revenue and incur expenses, and whose operations are regularly reviewed by the chief operating decision makers. So you have that in your notes. Then number 2, describe the condition that an operating segment must meet for it to be deemed a reportable segment under IFRS 8. So note this. In this case, they're asking, what about the condition of which you identify a reportable segment? It's not about the disclosure requirement. So in this case, we say there are 4. Number 1, one of the conditions, it has meet the definition as per IFRS 8, the definition of an operating segment. Then number 2, its reportable revenue or its reported revenue from both the internal and the external is at least 10% of the total segment revenue. Then its profit is at least 10% of the total segment profits, and then its asset is at least 10% of the total segment profits. Then number B, evaluate the advantages and the limitation of the following approaches of identifying a reportable segment. Remember, in our coursework, we say that we have 2 approaches you can use to identify a reportable segment. One, we have managerial approach, and then we have risk and return. And we listed the advantages and their disadvantages. So kindly pay a visit to your notes and go through that. Let me now do part C. Part C, I told that the following information was extracted from the book of Kerenga Limited for the year ended that 1st March 2012. So we have the sales, we have the expenses, other items, identifiable assets, and then we have the general assets. Additional information. Intersegment sales for the year ended that 1st March 2012 was follows. And then number 2, operating profit included that 3 million on intersegment sales. Number 3, information about the intersegment expense is not available. Required segmental financial information according to the requirement of IFRS 8. So we prepare the segment report. And this is Kerenga Limited. Segment report for the year ended that 1st of March 2012. So we have food product, plastic, we have pharmaceutical, and we have others. Then we can reconcile, then we get the total. So we start with the sales or the revenue. And in this case, we have to show both the external sales and the intersegment sales. And then you get the total sales. So we have the sales, and for the food product, that's the total. It's 5650. For plastic is 625. 345, and then we have 162. Then let's go to note number 1. Note number 1, you're told that the intersegment sales for the year ended that 1st March 2012 was follows. So we have the intersegment sales. So for food was 55, 72, 21, and 7. So with that, now we can be able to get the sales, external sales. 55, 95. Uh, 553. Uh, 324. And this is 155. Now let's reconcile that. So can you add the total sales from external, the external sales? And the total we have is 6627. You take it to the total, and then we have the intersegment, add the total intersegment. And you have 155. You take it to the reconciliation, and then you show them as negative. So to the total, you show 155, and the total should be 6627. Good. Then below the sales, you need to show the profit. How much was the profit? So based on the information given, you are not provided with the profit. But number 1, when you are showing up the segment report, there are some items which must be reported. One is the revenue, also the profit. Even if you're not given the profit, you have to recognize it. And how do you get the profit? So in this case, we are given the specific expenses. We have the expenses. For food was that 335, 425, 222, and for others there was we had 200. If you take the total revenue, you raise the expenses, that's how you get your profit. operating profit, as simple as that. So you take the total revenue, you less the expenses. You have 2315. That's 200. That is 123. Here we have that 8, which is a loss. So that's how you get the operating profit. Then let's go back to the statement. Can you go back to note number 2? Note number 2, I told that operating profit include 33 on intersegment sales. So of this profit, so can you add the total? Add the total profit. We have 2315. You add 200. You add 123. Then you raise that 8, and you get 2600. But you're told that of that 2600, there is profit which is intersegment, an amount of 33. You take it to the reconciliation and you deduct it. So you deduct 33, and you have 2567. 2567. Let's go back to the statement. We have other items. Let's go to under other items. Under other items, we have general operating expenses. General operating expenses. That one you take it to the total because it's not specific to which segment. And there was an amount of 562. Then was income from investment. Come from segment, we have an amount of 132. And then we had interest expense. Take it to the total, an amount of 65 plus an expense. And with that, now we are able to get our net profit. So how much was the net profit? You just take 2567, that was the total operating profit. You add 132, but you raise 562, and then you raise 65. You get 2072. That's our net profit. Then we go to the assets. You are given identifiable asset for food product was 7320. $13.20, $10.50, $6.65. Then below it, we have general assets. Now, the general asset is the same as what we call the unallocated assets. General assets, so you take it to the total, an amount of 722. So the other total assets, that is 10,355. 10,355. And then you add the general assets for you to get the total assets. Total asset, you have 10,355. You add 722, you have 11,077. So you can take a screenshot of that. So once we are through with that, we can do the last question on segment before we go to another topic. So you open May 2015, question 4C. May 2015, question 4C. Yeah, this is all about IPSAS and the public sector. Now for public sector, it's IPSAS 18, not AFRS 8, but the accounting, everything will be the same. So Ministry of Trade and Industrialization, segment report. The year ended 30th of June, 2014. So let's first of all start with part one. Part one. In the context of IFRS 9, financial instrument, analyze how financial assets are classified and measured. Yeah, that's under IFRS 9. So that one, you go to your handout, we discuss that, and we say that we have three classification of financial instrument. One, we had available for sale. Number two, we have financial asset at fair value. Number three, we have held to maturity. And number four, we had loan and receivables. And we say that available for sale is valued or measured either at amortized cost or at their fair value. But we say that for the financial asset at fair value, which are short term, they are always measured at valued at fair value, also held for maturity. Held to maturity is the same as available for sale. So they are either measured at amortized cost or at fair value. But loan and receivable, they are recognized always at their book value. You cannot revalue your own. So kindly go through your handout. You have them in your handout, the financial instruments. Let's go to part B. With reference to IPSAS 20 related party disclosure, explain two reasons why disclosure of certain related party relation and related party transaction is necessary. So can you take your handout? Take out your handout, page 15. Yeah, that's another part that never misses. Related party disclosures or related party transaction. Handout, page 15. Can you see them there? You have everything on the related party. So kindly go through that. Then part A was for financial instrument. Financial instrument, let's go back to the past question paper. Right, handout page that too. Handout page that too. That's why you'll have that information on financial instruments. Now for both IPSAS and for other profit entities, that's under IFRS, they are the same actually. So for financial instrument, handout page that too. For related party disclosure, handout page 15. Good, let's go to part C. Part C. Part C, I told that the following information related to Ministry of Trade and Industry for the fiscal year 2013-2014. So you have the primary service, tertiary, special, and others. We have the segment revenue, appropriations, fees from external services, and then we have the intersegment transfer. Now the intersegment transfer is the same as what you call the intergroup sales or revenue. Then we have the segment expenses, salaries and wages, depreciation, other expenses. Then we have other information, segment asset, segment liabilities. Additional information. Unallocated central expenses amounted to 70 billion. Then number two, interest expense and interest revenue amount to 20 and 40. Unallocated central assets and allocated liability amounted to that. Required segment report consistent with the requirement of IPSAS 18 segment report for the Ministry of Trade and Industry to be included in the financial report of the ministry. So we have four segments here. One is the primary services. We have for tertiary, special, Then we have others. Then we can reconcile, and then you get the totals. So we start with the revenue. And for the revenue, we have appropriations. Then we have fees from external services, and then we have the intersegments. And then we get the totals, total revenue. Let's call it A. So let's add the total. We add the total. So for 80 plus 150, that's 30. Also, here we add this total, that's 500. That is 300. Here we have, that's 360. Then let's add the total appropriations, revenue from appropriations. You take 480, we add 400 to 20 to 30, and the total you have is 1330. Then you add from external, that's 90, 110, that's 170. Also, we had the intersegment revenue, 160 plus 130. And that one you have is 290. Now, for intersegment, we said you bring them to the reconciliation. That's 290, but you show them as negative. So 290. So how much will be your total? The reconciliation. Just take 1330, you add 170, and you'll have 1500. Then, once we have the revenue, you have also to report the profit. Do you have the profit? So in this case, you're not given the profit, but you can get the profit since you are given the segment expenses. So let's go to the expenses. And for the expenses, we have salaries and wages. Then we also have depreciation. And then we have other expenses, so that we can get our total expenses. So let's get our total expenses. So for salaries and wages, we have 390, 310, 130, 130, 90, 70, 50, 70. And for other expenses, 110, 190. So now let's just get the total. We have 390 plus 90 plus 120. We'll have 600. And the total expenses, you can call it B. So now we have the total revenue and we have the total expenses. So can we get now the operating profit? But for the government, they don't call it profit, it's the operating surplus. So let's get the operating surplus. You just take A minus B, or the total revenue minus total assets. So 630 minus 600, you get 30. 500 minus 490, you get 10. 300 minus 280, you'll get 20. 360 minus 290, you'll get 70. You'll get 70. So that's the profit we had. Do you have any intersegment? No, so let's add the total. You add the total operating surplus. So that's 40, 50, 60, that's 130. 130. Didn't have any intersegment profit. Then let's go to additional information number 1. Unallocated central expenses amounted to 70 billion. We have central expenses, you take it to the total, it's unallocated, that's 70. Then number two, interest expense and interest revenue amounted to 20 and 40. So we had the interest expense, and also we had the interest income. The interest expense was 20, and income was 40. So you raise 20, you add 40, so that now we can get our net surplus. So for net surplus, you take 130, you add 40, you deduct 90, and you have 80. So that was the net surplus from the Ministry of Industrialization. Then another information, we have segment assets. And for segment asset, we have 540, 500, 340, 300. Then we have unallocated assets. So that now we get our total assets. So can we go to note number 3? Unallocated central assets and unallocated liabilities amounted to 350 and 400. So unallocated asset, we had 350. So we add the total. You have 1680. 1680, you add 350, and the total assets will be 2030. Also, we go to the segment liabilities. For segment liabilities, we have 250, 150, 80, 110, and also we had the unallocated liabilities. Unallocated liabilities, that's note number 3. It was an amount of 400. So that we get the total liabilities. So you have it's 590, you add 400 and you get 990. Good. So simple as that. So you can take a screenshot of that. So now let's do another topic that never misses. That's share-based payment. Share-based payment. So open with me December 2011. I'd given this question as an assignment, but most of the students failed terribly. December 2011, question 3C. So hope we are there. Let's start with part B of the question. Explain any 4 criteria that are used to determine the related party relationship as per IAS 24, related party disclosure. So kindly go through that. It's still under related party. And also for those who are doing advanced auditing, you can also use the concept of advanced auditing because they are the same. That's the related party transaction and disclosure. Part C, you are told that in the context of IFRS 2 share-based payment, explain 3 types of share-based payment. Types of share-based payment. And we say that we have 3 types of share-based payment. One, we have what we call equity settled share transaction. Number 2, we have cash settled share transaction. And number 3, we have the hybrid or combined cash and equity. Roman 2, you're told that the word limited grants to each of its 400 employees 10,000 options. If you get 10,000 options, so options are the same as the shares. So in this case, that's what we call equity settled share transaction. Remember, I said that under equity settled share transaction, the shares are measured at value based on the grant date price. But under the cash settled share transaction, the shares are valued and measured based on the share price at the end of each reporting period. That's the difference between the equity settled and the cash settled. So in this case, they are given 10,000 share option. So that means it's an equity settled. So the word limited grants to each of its 400 employees 10,000 options to purchase shares in the company on the condition that they remain in the word limited employment for the next 4 years. So those are the vesting condition, and the vesting period is 4 years. Each option has been valued at that 5. So that's the grant date price. The word limited predict that 5% of the employee will leave the company in each. Can you underline each? That's where most of the students failed. There's a question we did in class where you're told that the company estimates that 20% will leave in the 3-year period. So there is a difference between 5% in the 3-year period and 5% in each. So when you talk about in each, that means use reducing balance. 5% of the employee will leave the company in each of the next 4 years and will thus lose their option right. Required. Show how the word limited should reflect this arrangement in the context of the next 4 years in the statement of comprehensive income and the statement of financial position. So you bring the period, equity, and then the expense. It's 4 years, 1, 2, 3, 4. And how many employees do we have? We had 400 employees. Then we are told that 5% of they estimate that 5% will live in each of the next 4 years. So the first one is 400 employees times if 5% they live will only be having 95%. In the second year, you take 400 times 95% times 95%. Third year, 95% times 95% times 95%. And here it's 95 times 95 times 95 times 95. Or let me make it easier for you. Let me make it easier for you. You can also do this. It's 400 employees. If 5% leave, that means we'll only be having 95. So 95% of 400 is how much? You'll get 380. Now, in the second year, you'll take 380, an additional 5% leaves. You multiply by 95%, and you get 361. Then you also take 361 times 95%, and you get 343. And then 343 times 95%, you get 326 employees, which are the same as taking 400 times 0.95. The second year, you take 400 times 90%, or 400 times 95 times 95. You still get the same. Then once you get the number of employees, each employee was granted 10,000 shares. Then each share was valued at a grant date price of 15, and then you amortize it over the next 4 years. So the first one will be 1/4, 2/4, 3/4, 4/4. So what do we get? So that's the mean being 1,000. So it's 14,250. Have is 27,075. If you have, it's that 587.5. 900. So what do you take to the expense? So the first year is still 14,250. The second year, there was an increment from 14,250 to 27,075. So that increment is an expense. And you have 12,825. Then that 587.5 to minus 27,075. So how do you account for that? So what do you debit or do you credit? So in the first year, second year, third year, fourth year. So you debit number one, the expenses, and you credit equity. So expenses to the income statement, you take 14,250 in the first year, 12,825, 11,512.5, you have 10,312.5. To the equity, you take 14,250, 27,075, that 8,587.5, 48,900. So you can take a screenshot of that. So we can try another one. Let's try another one. November 2018, question 1C. November 2018. But you are told that on 1st January 2015, G Limited granted each of its 200 employees 500 share option. So therefore, this is an inequity settled. These share option were to vest if the employees still worked for the entity as at that 1st December 2017. So those were 3 years. The grant date was 2015, 2016, and they were given until if they will be in the employment as at the end of 2017. Those are 3 years. Then you're told that on the grant date, the fair value of each option was 15. So that's the grant date price. The share price of that 1st December 2015, that's at the end of the first year, was 27. And it was considered unlikely that the share price would rise above 45 by that 1st December 2017. 20 employees left the company during the year ended that 1st December 2015, and further 20 were expected to leave in each of the 2 years ended that 1st December 2016 and that 1st December 2017. During the year ended that 1st December 2016 and that 1st December 2017, 15 employees and 25 employees left the company respectively. Required extract from the financial statement of G Limited for each of the year ended that 1st December 2016, 2017, 20, and 2017. So how do we account for that? Number one, we determine the number of employees eligible in each year. And we had 200 employees. 200 employees. Then in this case, the company is making a provision. And in this case, they have 2 vesting conditions. One of the vesting conditions was about the share price. But the share price in this case is not within the control of the employees. The other vesting condition was that the employee need to be in employment as at that 1st December 2017. Now, what happens if the employee is able to fulfill their vesting condition? That means the employment in 2017, and the share price does not exceed what they agreed. So in that case, also they are eligible to get the share, because in their case, they are able to fulfill their vesting condition. It's only that the share price is not within their control. So we had 200, we minus. Let's go to the 3rd paragraph. I mean the 4th paragraph. You are told that 20 employees left the company during the year ended that 1st December 2015. So in 2015, 20 employees left the company. Then you are told that, and further 20 were expected to leave in each of the 2 years ended that 1st December 2016 and 20 in each. So in the first year, 20 employees left. But then they also made a provision. They also estimate that in year 2016 and 2017, they expect 2020 further will go. So in that case, you don't make the provision for those who expect them to leave. So you raise 20, you raise another 20. Those are the actual number who left the first year, and then the estimate of 20 in each of the following 2 years. Then let's go to 2016. 2016, we had 200 employees. You ask yourself, how many employees left the company in the first year in 2015? In 2015, the actual number of employees who left was 20, minus, as at 2016, remember you're told that they expect 20 to leave in each of the following 2 years, 2016 and 2017. So the actual number of employees who left 2015 was 200, minus, they'll have also, let's go to the last paragraph. During the year ended that 1st December 2016 and 2017, 15 employees and 25 employees. So the question is, how many actual number of employees left the year during the year 2016? 15 left. So let me repeat again. We had 200 employees. During the first year, 20 left. 2016, 15 left, minus, remember there was a provision. So by the end of 2016, remember they had estimated that 20 will leave in each of the following years. So they have to less the provision for the next year, 2017, and the provision was 20. And then now 2017, now that's when I use the actual information, because by the end of 2017, now you have the actual information. Number one, how many left in the year 2015? 20 left. How many left in year 2016? 15. And how many left in year 2017? 2017, they left 25. So in short, the first and the second year, you are just making a provision. And then 2017, now you have the actual information. You work with the actuals. So get the number of employees. Then you multiply. Each employee was given how many share options? 500 share options. And each share, the granted price was 15. Yeah. On that date, the fair value of each option was 15. That was the granted date price was 15. And then you amortize 1 of the 3 years, 2 of the 3 years, and then 3 of the 3 years. So what do we get? Getting 350. $725. Get 1050. So what do you take to the expense? So you'll have 350. So from 350 to 725, there is an increment of 375. From 725 to 1050, there is an increment of 325. So what do you present to the balance sheet? So what do you debit? What do you credit? You debit expenses, and then you credit equity. So first year, second year, third year. So to the expenses, you show 350,000, 375,000, and 325. 350 to the equity, 725, 1050. But that was not what the question was asking. Can you go to the required? The required, they wanted an extract from the financial statement. For the financial statement extract, so let's come up with income statement extract. The income statement extract, you just go under other expenses. Under other expenses, we have the staff cost. The first year, the second year, the third year. And they will take 350, 375, 325. It's just an extract. Then what do you take to the balance sheet? So statement of financial position. Extract. The first year, the second year, the third year. So you'll go under equity. So under equity, we issued shares. So ordinary share capital. We had made a provision, 350, 725, and then we have 1050. As simple as that. Can take a screenshot of that. Open it with me, May 2016. May 2016. Question 4C. May 2016, question 4C. So you are told that XYZ Limited issued share option to staff on 1st January 2013. The details relating to this share option are as follows. So you have the number of staffs, the number of option to each member staff. So therefore it's an equity settled. Vesting period, 3 years. Fair value at the grant date, per option is 30. Expected employee turnover per annum, 5%. So we had 3 years. So it was issued, the grant date was 1st January 2013. And the vesting period is 4 years, 3 years. So 2014, it is to mature in 2015. Then additional information. In the financial statement for the year that 1st December 2014, the company revised this estimate of employees turnover to 8% per annum for the 3-year vesting period. In the financial statement for the year ended that 1st December 2015, the actual employee turnover had averaged to 6% per annum for the 3-year vesting period. Option vest as long as the staff remain in the company for the 3-year period. Required. The charge to be made for the statement of comprehensive income for the share-based payment in conformity with the requirement of IFRS 2, share-based payment, in each of the 3 years. So that's very easy. How many employees do we have? The number of staffs we had? 1,000. Good. So this is a question that most of the students, they failed. Whatever what was going on. So in this case, we have 3 years, 2013, 2014, and 2015. So in this case, they are working with the provision, not the actual information. And we are told that before the additional information, that the expected employee turnover was how much per annum? 5% per annum for the next 3 years. So in short, you multiply by 95%, you multiply by 95%, you multiply by 95%, you are making a provision for the 3 years. But let's go to additional information number 1. The financial statement for the year ended that 1st December 2014, the company revised its estimate of employees turnover to 8% per annum. If it's 8%, 100 minus 8, you get how much? 92. So it's 92% for each of the 3 years. 92%, 92%. Let's go to additional information number 2. In the financial statement for the year ended 1st December 2015, the actual employee turnover had averaged to 6% per annum for the 3-year vesting period. So you multiply by 90, 94%, 94%, 94% for the 3 years. You get the employees, the number of employees who are eligible to get the share options. Then you multiply the number of options to each member was 500. You're getting 500 shares. Then you multiply how much was the grant date price, and the fair value of the grant date per option was 30. Then you amortize 1 of the 3 years, 2 of the 3 years, 3 of the 3 years. So I think with that now you can be able to determine that. So the first one is 1,000 times 0.95 times 0.95 times 0.95. Then you multiply by 500 times 10. So here you have 428,675. You do it for the second year and the third year, and then you get the expenses. And then you know how to treat them. So you show what do you debit, what do you credit. You debit expenses, you credit equity. So you can take a screenshot of that. So once we are through with that, let's do the last question. For November 2020. The option never misses. November 2020. Question 3A. November 2020. So we are told that. Yeah. So we are told that. Madini Limited issued share option to its directors on 1st January 2019. So they issued shares. So it's an equity settled. So it's period, equity, expenses on 1st January 2019. The option had a vesting period for 10 years and had a fair value of 20 million as the date of issue. So given the fair value of the option, that's the total. In order to be eligible to exercise the share option, the directors are required to remain in the employment of Madini over the entire vesting period. I actually have estimated that 20% of the directors who have received the share will leave the employment in Madini Limited over the vesting period. Now note that it's 20% will leave over the 10-year period, not 20% in each of the 10 years. So kindly understand that. They estimate that. So in short, of all the 10 years, it's only 80% who will qualify. The financial year end of Martin is that 1st December. So required. Advise the management of Martin Limited on how to account for the share option in the financial statement for the year ended that 1st December 2019. It was issued on 1st January 2019. So how do we recognize that as at the end of the first year, that 1st December 2019? So you just take period 1. That's what they want. That is 2019. Now, the entire equity, you are told it had a fair value of 20 million. Of this 20 million, you expect 20% will leave. So it's only 80% of this which will qualify. And then you amortize it for the 10 years, 1/10. What do you get? 20 million, you multiply by 0.8, and then you divide by 10, and you have 1.6. Now for the second year, but in this case, we don't require for the second year. They only wanted, how do you report it on that 1st December 2019? So that means the expense still will be 1.6. So how do you account for it? So what do you debit? What do you credit? You debit expenses. That's the director's fee, an amount of 1.6, and then you credit equity, an amount of 1.6. It was simple as that. So that's how you are getting your 6 months. Good. So you can take a screenshot of that. So, and that marks the end of that session. So God willing, tomorrow we have another AFR session. So tomorrow from 4 to 6, should have a date on that. So and from now henceforth, we'll be having 2 sessions until you do your exams per week for AFR. So that's the end of the session.